Imagine you could peek into your financial future just for a moment. What if I told you that every time you did, there was a nearly 50-50 chance you would see something that causes you pain? This isn't a hypothetical scenario. If you check your investment portfolio every single day, you have a 46% chance of seeing a loss on any given day. That figure is not just a statistic. It is a direct challenge to your emotional stability. It pits your deeply ingrained human instincts against the cold, impersonal movements of the market. Your brain is wired to react, to do something when faced with a perceived threat. The market, however, is simply fluctuating. This daily battle is one you are predisposed to lose, not because you are a bad investor, but because you are human. The constant exposure to these daily swings creates a state of high alert that is detrimental to long-term thinking. Your mind registers each downward tick. Our relationship with money is fundamentally asymmetrical. The pain of losing $100 stings far more intensely than the pleasure of gaining $100 feels good. This powerful psychological principle is called loss aversion. Decades of research in behavioral economics have shown that the emotional impact of a loss is roughly twice as powerful as the joy from an equivalent gain. When you check your portfolio and see red, your brain does not just register a financial fact. It experiences a genuine, visceral sense of pain. This is not a sign of weakness. It is a feature of our evolutionary wiring, designed to make us acutely aware of threats. In the world of investing, however, this feature becomes a bug. Compounding this effect is a phenomenon known as myopic loss aversion. The myopia here refers to our natural tendency to focus on the short term. We give far more weight to what is happening right now than to what might happen over the next decade. When you combine this short-sighted focus with the sting of loss aversion, you create a toxic brew for any investor. The solution to the pain of frequent checking is deceptively simple. Look less often. The magic here is rooted in the mathematics of market returns over time. The data paints a clear picture as you zoom out. If you check your portfolio daily, you have a 46% chance of seeing a loss. That is nearly a coin flip. Your emotions become hostage to randomness. Now, extend the time frame. Check only once a year. The probability of seeing a loss drops dramatically. Historically, the U.S. market ends the year in the red about 21% of the time. Instead of a coin toss, you have about a 4 in 5 chance of a gain. This habit change does not alter the market. It changes your experience. Stretch the horizon further. Any 20-year rolling period in S&P 500 history, chance of losing money is nearly zero. That does not mean no downturns, no bear markets, no terrifying crashes. Over long periods, growth and earnings overpower volatility. The upward trend is the dominant signal. Daily dips are just noise. Focus on 20-year outcomes. Time is your greatest ally. Reframe what you see on the screen. A down day is a 46% probability event, not a crisis. A down year is a 21% event. Unfortunate, but expected. To make this tendency more concrete, let us give it a name: the Alex effect. Alex is a diligent saver who wants to do the right thing. But Alex has a habit. They check their investment app several times a day. One morning, the market opens down 2%. Alex sees the red number next to their balance and feels a jolt of panic. The pain, amplified by loss aversion, is immediate. Headlines flood the mind. The urge to stop the bleeding becomes overwhelming. Alex sells a portion of their holdings, feeling brief relief. This is the first step in a destructive cycle. By selling after a drop, a temporary loss becomes permanent. Markets are volatile, and rebounds can come as fast as downturns. A few days or weeks later, the market recovers and climbs, but Alex is on the sidelines. Now, a new dilemma: when to get back in. Fear of another drop causes paralysis. Re-entry often happens only after prices are higher. Emotion drives the opposite of what works, buying when it feels safe and selling when it feels scary. Each loop chips away at compounding. Over a lifetime, this can cost millions in lost growth. A quiet thief. Abstaining from checking does not mean ignoring forever. Reviews should be intentional, scheduled, and tied to specific reasons. There are only a few good reasons to look. Think of these as the 3 sacred times. First, a major life event, getting married, divorced, changing careers, having a child, or receiving an inheritance. Big life changes require reassessing your strategy. Second, scheduled rebalancing, realign to your target allocation. For example, 60% stocks and 40% bonds on a fixed schedule once or twice a year, or when drift hits a set threshold. Third, before a large planned withdrawal, buying a house, paying for a renovation, or funding the first year of retirement. Plan which assets to sell and consider taxes well in advance. If none of these conditions are met, there is no good reason to be checking. Trade impulsive glances for purposeful reviews. Remember, rules protect you from you. Knowing you should not check is one thing, stopping yourself is another. The key is friction, small obstacles that slow you down. Friction is the antidote to the Alex effect. It creates a buffer between trigger and action. Remove temptation. Delete investing apps. Delete financial news apps. Turn off notifications across broker, news, and market data. Require a computer, a browser, and a login. The multi-step flow forces the question, do I really need to see this right now? Pair friction with automation. Schedule automatic transfers and investments on a fixed cadence every payday, so new money is invested without emotion. Create external systems, 1 or 2 annual reviews as immovable appointments. A 48-hour cooldown after scary headlines. Hide summary balances to avoid the emotional hit and focus on the specific task, like confirming a contribution. More often than not, the answer to checking right now is no. And that is freedom. The path to becoming a calmer, more successful long-term investor is not about a secret insight. It is about managing yourself. Build a simple, robust system that protects you from your worst instincts. The market will always have noise, volatility, and occasional panic. Your job is not to predict it, but to endure it. The quiet, patient investor almost always wins the matchup with the frantic, active one. Your greatest advantage is temperament, and you can train it with rules. First, make checking harder. Delete investment apps and hide balances on your web dashboard. Second, put your savings on autopilot. Automate monthly contributions. Third, be intentional. Schedule reviews once or twice a year. Only look after a major life change or before a planned withdrawal. During high volatility, stay away. Your pre-written plan is your shield. Trust the work you did when calm, not the fear you feel in the moment. The goal is not just better returns. It is a better quality of life, family, career, well-being. The market is a powerful tool for building wealth, but a terrible master.